To all my listeners, whether you're a gold bug or you're concerned about inflation and protecting your capital, you need to check out my brand new conversation with Dan Ferris on the Stansberry Investor Hour podcast out now. You can easily access the episode by clicking the link in this video description box. Hope to see you there. Hi, this is Daniela Cambone, and welcome back to Stansberry Research. My guest today is easily one of the most recognizable faces in the financial landscape. He was previously retired, but now he is back. So please welcome to the show, Dennis Gartman of the Gartman Letter. Dennis, I'm thrilled to be back with you. Welcome back.
It's good to be. I've actually been around. I'm still the chairman of the University of Akron's Endowment Committee, and I'm on the board of directors of NC State's endowment, and I have my own money at risk. So I've still been around. It's just that I don't do the daily newsletter anymore. I had, to be quite honest, I've got Parkinson's disease, so it's been very difficult typing, and that was the reason why I retired. But after 35 years of getting up at 1 o'clock in the morning, I'd had enough.
I can understand that, but we're thrilled you're back. Your words and thoughts were greatly missed, and obviously we have a lot of things to talk about today.
Sure.
So first, let's get started with your recent roundup of the market. I know you are bearish equities. You believe the bear market started in early January. Let's talk about this. Why?
I think it's absolutely incumbent to understand that the Federal Reserve Bank has said that they intend to abandon quantitative easing, which has been, I think, overdone for a long period of time. The fact that the Fed took its balance sheet from what, $8 billion to $9 trillion over the course of the decade is inflationary and expansionary. There were times when they had to do what they had to do. Expanding reserves back in 2007, 8, and 9 was wise. Expanding reserves last year with COVID was wise, but they probably overstayed their term in office. And they've made it abundantly clear that beginning in March, they will end quantitative easing and begin the process slowly of quantitative tightening. They've taken the fuel away from the bull market in equities, which has been that I think has been the great sponsor of the bull market for the past year and a half or two. And that fuel is being rescinded. I think it's overdue. I think it's long past time. And I think that people have to understand that that's the process going on. Now, clearly today and yesterday, we had the advent of Ukraine, which has added a bit of spice to an already bearish concern. But I was bearish beginning January 5th, when the Federal Reserve announced that QE was actually going to come to an end. Mm-hmm. And since then, there have been more comments. We have to be careful about the fact that, and I think this is important, is that the Fed has said that QE is ending, QT is coming. And I've been concerned that they would actually begin the process of selling securities from their portfolio. I hope that that's not true. I hope they simply allow their securities to mature off. But that's a reduction in fuel to the bull market, and therefore I am bearish of equities.
And before I ask you how bearish and what kind of correction we're talking, I just want to highlight one quote from your recent letter to your point there, where you say, but far more serious and far more hawkish were Miss George's comments, that's Esther George you're referring to, suggesting that the Fed might err toward actually selling off part of its investment portfolio of treasuries and agencies rather than allowing them to roll off through maturities. Let's talk about that and why you think this is so serious.
Well, heretofore, when we understood that they would allow their portfolio to roll down, to mature off, as 2 years become 6 months, become 1 month, become overnight securities, they would mature and disappear. And that would reduce the size of the Fed's balance sheet. It's different to actually come out and say, we're going to sell securities from our balance sheet. That's a completely different attitude. That's far more efficient, far more serious, far more severe. And I think people need to pay attention to that fact. We have 2 voters on the FOMC this year, Miss Esther and Miss George, or Miss Mester from Cleveland and Miss George from Kansas City, who have been and will consistently be the most hawkish of the FOMC voters and the FOMC members. And Miss Esther has said that she intends, or is at least considering, selling securities. That's a very serious statement.
So, what kind of correction do you foresee for equities then?
Well, historically, from the high to the low, usually something if we go through a normal bear market movement to the downside without a recession, it's 15 to 20%. If we actually have a recession, and we shouldn't be too concerned about a recession until the yield curve moves to an inversion. Mm-hmm. And I hope that that's not what happens. That might could occur, but I don't think that shall occur now. But if we took the yield curve to an inverted curve, then the possibilities of recession become severe. And then suddenly you're talking about 25 to 35% to the downside. Let's just say that 15 to 20% is probably reasonable. And we've actually gotten there relatively quickly from the January 5th highs to yesterday on Thursday. We were down almost 17%. So you're at the 15 to 20% boundary already.
So with the correction, with the stock market taking a hit, will they at least be successful a bit in curbing inflation? Or is this all being done in vain?
The problem is that as we learn over time, inflation is always and everywhere a monetary phenomenon. And there's a 2 to 3 year lag between the growth of the monetary aggregates, the growth of the Fed's balance sheet, and when inflation occurs and how long it continues. So the fact that we are moving from quantitative easing to quantitative tightening is a good move, but there's going to be a lag effect on inflation. I think we're going to be seeing 5, 6, 7, 8% inflation for the next 2 or 3 years, even with the Fed beginning the process of tightening, because of the lag effect that is normal to be expected.
Dennis, you're bullish gold. We see gold's movement. We saw gold's movement on Thursday in the face of the geopolitical uncertainty. Where does gold go from here?
Probably higher. It's moving from the lower left to the upper right. It probably will continue to move higher. There are times when one is to be bullish of gold. There are times when one is to be bearish of gold. And there are times when one is to be neutral of gold. But given the monetary aggregate growth of the past several years, given the fact that inflation is now obviously clearly not transitory, clearly there's a lag effect, as we just talked about, between the growth of the monetary aggregates and when inflation occurs and begins to subside. We have, I think, 2 or 3 years of inflation to deal with. And I think that that's going to be the process of engendering even higher prices for gold over the course of the next several years. So gold is now above $1,900 an ounce. Can it go to $2,200, $2,300, $2,300 an ounce over the course of the next 2 or 3 years? The answer to that is yes.
We see how gold is responding. We see how Bitcoin is responding. Should we be reading into anything at this point?
Bitcoin is something I miss the Bitcoin boat. I find Bitcoin to be amusing. I find it to be disconcerting. I find it to be a silly concept. Between Bitcoin and NFTs, I find the whole thing to be utterly irrational and makes no sense whatsoever. So as I've said for months and months, and I will continue to say, Bitcoin could go to $100,000 a piece and it shall do so without me. I'll let other people who are either far more interested in Bitcoin, far more intelligent about Bitcoin, or far more unintelligent about Bitcoin trade Bitcoin. I have no interest in it whatsoever.
Dennis, thoughts on oil trading above $100 now? Where do we go from here?
Watch the term structure. Watch the relationship between the front month, the second, third, fourth, fifth, 6 month back. In great bull markets, in storable commodities, whether it's cotton, soybeans, corn, wheat, or most particularly crude oil, watch the term structure. In great bull markets, the front month on up days goes up more than the second, third, fourth, fifth, 6 month contract back. And on down days, it loses less. On bull markets, the backwardation that we now see, where the front month is higher than the second, third, fourth, and fifth market back. In good bull markets and sustained bull markets, that backwardation should widen every day. And the backwardation has been widening for the past several months. That continues to tell me that there's a tightening of the supply, an increase in demand. Now, perhaps the weakness in the stock market may ameliorate some of the demand factor, but nonetheless, the supply is diminished and the backwardation continues to widen. So as long as the backwardation continues to widen, you have to err bullishly of crude oil. Where can crude oil go? It surprises me that we're at $100 a barrel. It'll go until the backwardation begins to narrow. Watch the term structure. It is the best leading indicator I can imagine when it comes to watching a storable commodity, and particularly crude oil.
Would love to get just some quick thoughts here on silver. As you know, a lot of people hoping for triple-digit silver. Are you as bullish silver as you are gold?
Quite honestly, no. I pay very little attention to the silver market. I'm 71 years old. Silver is far too speculative, far too erratic, far too beta intensive than is gold. I'll let other people trade silver. In bull markets, silver tends to gain upon the gold market, the operative word here being tends. I can understand why people would want to be bullish of silver if they're bullish of gold, but I'll let other people trade silver. My focus is upon the far more liquid market, which is the gold market. I'd much rather err bullishly of gold than of silver. But in a continued bull market, if gold goes to $2,200 an ounce, is silver going to go higher? No question.
So any other area of focus that you think we should be looking at right now? Obviously, you're very bullish gold. Anything else that we have to be paying attention to?
Pay attention to what's going on in agriculture. There's an interesting phenomenon For the first, well, actually, it's only going to be the second time in the last 20 or 30 years. The amount of acreage that is going to be planted to soybeans here in the United States is going to be larger than the amount of acreage planted to corn, because there's a complete lack of fertilizer. It's very difficult to buy fertilizer. If you can, the price is extremely expensive. And if you're a corn farmer, you need fertilizer. You need to put nitrogen in the field. Soybeans don't need it. So there's going to be a switch of rather several million acres out of corn into soybeans. Now, we always have to remember, American farmers love to plant corn. So even though you think that the numbers and the fundamentals of an inability to get nitrogen and fertilizer would tend to diminish the amount of corn acreage, it won't be as much as a lot of people think, but there's going to be a change. And I think you need to err upon the side of being bullish of the corn market, even after the rally that we've had. Buy any weakness that you get in corn probably because of the change in acreage this year. We're also going to see a reduction in the amount of corn acreage here going into cotton basically for the same reason, that corn requires a great deal of fertilizer, and cotton you have to put your hands on it, but there'll be a change in the amount of acreage of the cotton production also. Pay attention to what's going on in agriculture.
I just want to get back to your point on inflation here, Dennis, and then we'll talk Russia for a second. But inflation, how out of hand does it get? Have we reached peak inflation? Where are we at?
We're probably in the third or fourth inning of the inflationary cycle. That we've probably got 6 innings in baseball terms that we have to go. Do I think that inflation is going to be back to the numbers that we saw back in the 1970s when I first got in the market? No, we're not going to see those sorts of inflation numbers. But are we going to see sustained 5, 6, 7% inflation on an annualized basis for the next 3, 4, 5, or 6 years? Unless all the rules of monetary expansion have been rescinded, and I don't think that that's true, we're going to see inflation be with us for a long period of time. And it's going to be deleterious. It's going to be very difficult for the bottom half of the economic income levels. They're going to have a hard time for the next 2 or 3 years. Gasoline prices are going to stay very high. Food prices are going to stay very high, and wages probably will not keep up.
Dennis, finally, you say history doesn't repeat itself, but it definitely does rhyme. So with Russia invading Ukraine, are we seeing the next link in rhythm here? This is just the beginning. Any insights or feelings of how this will evolve?
I must admit, I misunderstood Mr. Putin. I thought that he would be content sitting with the 2 Eastern republics that he declared independent earlier this week. I never really expected to see him move his military forces into Ukraine itself. I'm surprised that he's done so. I think he's made a terrible mistake in doing so, and I think he's riled up the West to a position that the West will probably not only put more severe sanctions into place, but they'll actually motivate and mobilize the NATO troops. I think he's made a terrible, terrible mistake, and I think he'll pay dearly for it in the end. But in the next 2 weeks, 3 weeks, month, he's going to be in the driver's seat, but that'll end. The Ukrainians themselves are going to take up arms against him. It's going to be a bloody guerrilla fight, and that's what I'm fearful of.
Right, and especially, his statement saying that if anyone gets in Russia's way, that he will be prepared to use means that,
We have to remember, one of the great comments I've heard is the former Senator John McCain, a great man, once said of Russia, it's a gasoline station masquerading as a sovereign country. And that's exactly what it is. It's really, Russia is demonstrably weaker militarily, demonstrably weaker monetarily, demonstrably weaker in population, demonstrably weaker economically. He's going to pay a severe price for what has happened here in the last couple of days. No question about that in my mind. But I must admit, I was surprised that he made the move that he has made Wednesday and Thursday nights.
Dennis Gartman, it's been an absolute pleasure. I'm happy to see you and to be back interviewing you, my friend. Thank you.
Good to see you, Danny. Take care. Be well, and take care of those kids.
I will. Thank you so much, Dennis. We'll see you again soon. And thank you all for watching. We'll have much more for you on Stansberry Research. In the meantime, don't forget to sign up for premier content you can't get anywhere else at danielacambone.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.